A very strong reception, certainly, for the unveiling of this streaming service. They did give us a lot of information, Jim, and investors seem happy about the price point and the total addressable market as well. One of the key reasons why that stock has performed so well in the last 2 days.
Yeah, I mean, I think they did an incredible job with that. I think they really established that this is going to be a must-have channel over the top. The pricing is very, very attractive to consumers. The growth story is good. And the stock, it's up 14% on the news. It's up like over 30% on the year. It's been a phenomenally, terrific stock this year. So let me just say, here's the cloud over this. Here's what worries me just a little bit. They have really done a brilliant job of changing the conversation to the growth opportunities, which is going to help boost the multiple, and away from the problem, which is ESPN, the cable networks, and cord cutting. There was nothing about the mainline ESPN in this presentation. And ESPN Plus, they seem to be conceding, at least for now, it's going to be kind of a niche product, maybe 10 million users. And that was the big cloud over the Disney stock. What is going to happen to that cable revenue stream from ESPN? Now, looking at their last earnings, it was surprisingly good. The cable revenue was very stable. The swift deceleration seemed to have stopped. But longer term, that has got to be temporary. Again, the very success of this new Disney direct-to-consumer product is going to cause more people to cut the cord or get the small bundles from cable, which is not going to include ESPN. And I have never seen any modeling that shows ESPN going direct-to-consumer that replicates the profits and revenues that they have from the cable model. It's a very good
point. It is something that Mr. Iger and I spent some time on during our interview in terms of discussing it, because they are not positioning ESPN Plus in the marketplace as a replacement for ESPN, at least not yet.
Right.
And he said, it's not a failing service. And I asked him, well, you know when it is? And he sort of indicated yes, but it's not now. But your point's an important one, I think, Jim, because that is, we do wonder what's the trajectory going to be like. The last quarter, they benefited from the growth in these virtual MVPDs, the likes of YouTube TV and Sling and the others that have been increasing subs. But even that is actually slowing. And so it is an interesting point as to what's going on.
That'll be something really to watch for when their earnings come out next month. Another minor issue here, but I think it is an issue, is they said they're going to spend roughly $1 billion this year on new content. That's impressive, but Netflix is spending $8+ billion on new content, and they're hiring they're snatching people away from the Disney fold. Some of the most impressive producers, writers are moving into the Netflix fold. So I wonder, is $1 billion enough? Now,
they'll get up to $2.5 billion over time. And obviously, there's license fees they're giving up that they would otherwise receive. And you've got to remember, the movie production arm is actually creating a lot of the content that then gets exclusively put into the service.
Which I think is positive. And they do have an incredible library. I think some people have overlooked the fact that Netflix, starting from scratch, they do not have the library. And again, I think a big part of the Fox assets is they've got good library assets there. Disney itself has rich layers of content. They can be, spewing that out forever. And a lot of it is absolutely timeless in its appeal to, new successive generations of young people coming up. So I think that there's a lot of terrific content there, but they, I think, may have to end up spending more than they realize to keep up with big spenders like Amazon and Netflix. Now, the other point, though, is their multiple is still a long way from Amazon and Netflix. There's plenty of room for multiple growth if people are really convinced that they're going to crack this direct-to-consumer, wipe out the middleman, and get the benefit of the doubt. I think they probably deserve the benefit of the doubt, but I think people are going to have to recognize there's going to be some tough quarters, if not years, in the immediate future.
But I know you're a fan of their balance sheet, right?
Oh, the balance sheet is unbelievable. I looked at it just recently, and I'm like, they could easily pay for the Fox. And they have amazing cash flow. They have a rock-solid balance sheet. They have very little debt. It's a fortress balance sheet. They can be a formidable competitor financially, and you couple that with their, demonstrated ability in the entertainment area, they are like a super strong competitor.
Yeah, well, the people, at least who make the decisions about buying and selling, seem to be looking past the next couple of years to that future you're talking about.
Well, that's
Jim.
what they had to do with this story, and again, I tip my hat to them. They really have changed the conversation. Nobody is really talking about ESPN right now.
No.